We'll continue with economics A level, cost. So today we're going to the economic definition of cost. So when we talk about the economic definition of cost, we are simply talking about opportunity cost. The the economic cost of production is what? The opportunity cost of production. So yeah, the economic cost of production for a firm is the opportunity cost of production. This is the value that could have been generated at the resources being employed in their next best use. So we call it economic cost of production or opportunity cost or imputed cost. These costs, we might not see them, but they are part of our decision-making process. So whatever we do, it might not be in cash, but whatever we do, those things will reflect on whatever our output are at the end of the day. So that's why we call them imputed cost. So here I wrote about imputed cost. I said it is a cost that is estimated for internal decision-making purpose, even though it is not an actual cash payment. You might not see them, but they are part of what we do. So example of imputed costs are one, for the labor. You know what labor is, right? People that work. So I wrote, the imputed cost of a worker is the amount of he or she would have earned if instead of working for themselves, they work for employers. So the economic profit is the difference between the amount he or she will earn while working for themselves and while working for employers. So we start with labor, which is an imputed cost. So let's say you have a business. Because you have a business, you earn money from it. So the amount of money you earn while working for yourself you might not be able to measure your time that you spend. But whatever the case might be, you have earned money, you have earned profit. So whatever you earn, the opportunity cost or the economic cost of whatever you earn is whatever you are unable to earn or what you should have earned working for your employer. So that is labor as an imputed cost. Get it again. We call labor as an imputed cost because you should have earned from your employer. Rather, you are working for yourself. So whatever you earn from yourself for yourself, if it is more than what you should have earned from your employer, that is an economic profit. So the economic profit is the difference between what you earn and what you should have earned by working for your employers. Do you get the difference here now?
Yes.
So there's labor, which is an imputed cost, because if you work for yourself, you make profits. So the difference between what you make for yourself while working for yourself from what you should have earned while working for others is your economic cost. If you would earn more working for yourself than when you work for others, it is an economic profit. Do you understand labor here?
Mm-hmm.
The reward for labor is wages. So if you earn more in terms of wages working for yourself, that is not wages anymore, it is profit. If your profit will be more than what you will earn in wages when you work for others, that's economic profit. But if you're going to earn less, that is economic cost. Is it clear? If you earn less working for yourself than working for others, it's an economic cost. Is it clear?
Yeah.
2, financial capital. When we talk about financial capital, we're talking about equipment, machines that we use. So an entrepreneur would spend more, an entrepreneur would invest on maybe in the business. So the amount of money he invested or she invested in that business, if the return is less than what he would have earned from investing in another business, that is the financial capital, which is an economic cost. So the economic cost of investment is the earnings you should have earned, the earnings you would have earned investing on other investment than the investment you actually invested on. So if I have invested in business A, the economic cost of investing in business A is the earnings I would have earned, the earnings of investing in business B that I did not invest on. Do you understand financial capital here?
Yes.
Then the third one is depreciation. And when we talk about depreciation, we're talking about the physical deterioration of an asset. So what is the economic cost of an asset? So I wrote, the economic cost of depreciation is the difference between the purchase price and the resale value of that asset. So you purchased an equipment. The difference between the amount you purchased it and the amount you're going to sell it after its economic life is the economic cost. Do you get it?
Yes.
The difference between the amount you bought it and the amount you are going to actually sell it at the end of its economic life. That is depreciation, which is economic cost.
Okay.
I think it's clear.
Yes.
Then we have the last one, which is imputed also, is the goodwill. And when we talk about goodwill, we're talking about the established reputation of a firm or of a business. So what is the economic cost of goodwill? The economic cost of goodwill is the interest you will not earn when you actually sell the business. When you're selling the business, with your goodwill, with your reputation, you're supposed to sell it more. Selling it more means you have earned certain interest. But the interest you won't earn because you are selling your business to probably your rival is what we call economic cost. Do you understand economic cost here?
Yes.
Any question about economic cost?
No.
Great. So that takes us to fixed and variable cost. Are you there? Good. So we go to fixed and variable cost. Why do we call it a fixed cost? We call it a fixed cost because this cost does not vary. It does not vary directly with output. So whatever happens to our output, this cost remains the same. So it is probably an indirect or overhead. Get the point here? We call it a fixed cost because this cost does not vary as output changes. That's why it is what a fixed cost. Then we have, now I got. I said, a fixed cost is a cost that doesn't vary directly with output. It can be called overhead or indirect cost. This means as the level of production changes, the value of a fixed cost will remain constant. So whatever your output is, your FC will remain the same. Examples of fixed costs are one, spending on capital goods like equipment, machine, land, building. Whatever your output are, these things will remain the same. The cost will remain the same. Another example is rent. Your rent is constant. You use it or you don't use it, you have to pay it. Salaries of permanent staff, the earned salary. So it is monthly, it is fixed. So you have to pay them at the end of the month. It is fixed. Spending on advertisement and promotion, they are also fixed. The amount you spend on advertisement will not change. If the advertisement brings more customers or not, it will still be the same you pay. That's why it is fixed. Do you get it?
Yes.
Any question about fixed cost?
No.
Good. And that takes us to what we call the variable cost. Why do we call it a variable cost? We call it a variable cost because this cost changes as output changes. It varies with output. So here I got a variable cost is a cost that varies directly to output. Examples are overtime payments. So maybe we have the wages, which is probably the piece rate or the time rate. Piece rate is what you earn based on the output you produce. So you produce 100 outputs, you get paid for 100 outputs. You produce 10 outputs, you get paid for 10 outputs. That varies, yes or no? Another one is payment on the raw materials. The quantity of raw materials you buy is what you pay for. If you are buying 100 units, you pay for 100 units. If you are buying 7 units, you pay for 7 units. So it means as output changes, it varies with the level of output. Do you understand that? So that's what we call a variable cost. Then we have some expenses that are in between the variable cost and the fixed cost. We call them semi-variable cost. What do I call it? Semi-variable cost, yeah. So for semi-variable cost, it's an expense that contains both a fixed and variable cost. So here, examples are utilities. When we talk about utilities, maybe your electricity bills. For example, a business might have a fixed monthly fee for electricity plus a variable charge based on actual usage. So you might have a certain fee that you pay on your electricity, but there might be a variable cost or expense that you pay based on how you use it, based on usage. So the combination of the amount you pay on usage and the service charge on usage and the fixed amount you have to pay becomes a variable, semi-variable cost. Do you understand utility here? Another example of semi-variable cost is a sales commission. A salesperson will get his salary and at the same time get commission on whatever he or she sells. So putting it together becomes what? A semi-variable cost for the firm. Not for the individual, for the firm. I think okay. So the firm, if the firm has to calculate that on its statement to calculate it as what? A semi-variable cost. Because the firm is paying salary and at the same time commission to certain individual. So the formula for semi-variable cost is FC plus VC multiplied by the number of units. FC plus VC multiplied by the number of units. That's how you calculate semi-variable cost. Any question about variable cost, semi-variable cost? No. Good. So that takes us to total cost, average cost, and marginal cost. Are you there? Good. So for total cost, why do we call it total cost? We call it total cost because it's the cost of producing a given level of output. That's why it is what? We call it total cost because it's the cost of producing a given level of output. That is why we call it total cost, which is TC. Then we have the total cost comprises of, it is TC equals to FC plus VC.
Variable and fixed.
Yes, that makes our total cost. So here I wrote, total cost of production is the cost of producing a given level of output, which I said already. So for total cost, we have total variable cost and total fixed cost, TFC and TVC. So how do we get our TVC? Our TVC varies with output. That's why we call it total variable cost. And for our VC, TFC, it does not vary. It remains constant irrespective of output. Our total variable cost varies with output. Our total fixed cost remains constant irrespective of output. Any question about that? So we have TC. TC is what? TVC plus TFC. Are you with me?
Yes.
Then that takes us to average. We have average cost. Are you there?
Yes.
So for average cost, it is I got average cost AC. AC. This is the total cost divided by the level of output. So AC is TC divided by Q. Get AC. We have TC. TC is TFC plus TVC. So AC will be TC divided by Q. Then for AC, we have AVC and AFC.
Okay.
So for AVC is the total variable cost divided by output. That is AVC. Then we have AFC, which is
Average.
total fixed cost, divided by output. Do you get it?
Yeah.
So the formula for AVC is TVC divided by Q. Then the formula for AFC is FC or TFC divided by Q. Do you get that?
Yeah.
Any question about that?
Yeah.
Then that takes us to marginal cost. Why do we call it marginal cost? We call it marginal cost because it's the cost of producing extra unit of output. We call it what? A marginal cost because it's the cost of producing extra unit of output. And the formula for marginal cost is change in total cost divided by change in output, or TC2 minus TC1. Are you with me?
Mm-hmm.
Any question about MC?
No.
So look at the table here. We have AVC, we have AFC, and we have AC. So when you add them together, it gives you your AFC. So AVC plus AFC would give you ATC. You get it there?
Mm-hmm.
Okay. And then we have, I think marginal cost is clear now.
Yes.
So that takes us to diminishing returns and short run. Are you there?
Yeah.
So go to diminishing returns and short run cost. I wrote, in the short run, a firm will be faced with employing at least one factor input, which cannot be varied. So increasing the variable factors on a fixed factor will initially increase output until the optimum level, which it reaches efficiency. Then diminishing marginal returns will set in, then average returns will also come in. So in the short run, there's always going to be diminishing returns. Why? Because in the short run, there's always going to be one factor input, at least one factor input that is constant, that cannot be varied. As a result of that, you continue, because it's in the short run, you will continue to invest or increase. A firm will always want to increase its output. But increasing your output on one factor input that is constant will increase output initially, but it's going to get to the optimum level where that factor input is mostly efficient. As soon as it exceeds that, it becomes diminishing. So diminishing marginal returns will set in, then the average returns will also set in. Do you understand?
Yes.
That's why we have diminishing returns in the short-run cost. There's a short-run cost because there's diminishing returns. And there's diminishing return because there's always going to be one factor input in the short run that is constant. Then you continue to increase the variable factor on the same factor input that is constant. It will work to a stage that will start diminishing. That is what we call diminishing marginal productivity. Is it clear?
Yes.
Any question about that?
No.
So that takes us to short-run cost schedule and short-run cost. Okay, here we have a table. Activity 3, I think you should be able to do that with the formula I gave you already.
Okay.
So we have the short-run cost schedule. I wrote, it is a table which shows how a firm's expenses change as it produces different quantities of goods or services in the short run. So we have a short run schedule based on the fact that our expenses will change as soon as our production changes in terms of goods or services that we produce. So a table that shows it is called the short run cost schedule. Clear? Any question about that?
No.
And that takes us to the short run cost curves. A short run cost curve is a graph which illustrates a firm's production cost when at least one factor input is what? Is fixed or constant.
Mhm.
So inside the short run cost curve, we have the total cost curve. What is the total cost curve I wrote? The TFC curve is horizontal straight line. It's an horizontal straight line, and it shows that the TFC is always constant at any given level of output. We have it here. The TFC is here on figure 2. You have it there. That's the TFC curve. Then we have the TVC. The TVC is parallel because it's vertical to the TFC. Then we have the marginal cost curve. Are you there? The marginal cost curve, the MC, is like this. It falls, then goes up. The MC, it falls, then start going up. Are you with me?
Mhm.
So the MC cost curve first falls and then rises as the initial marginal return setting. So we have it short run because it's we have it, we call it the MC. It falls, then it rises. It rises because there's what we call diminishing marginal returns. Do you get the point here?
Yeah.
So what are the points to note? We have a U-shaped AC and MC. So our average cost and our marginal cost curve are U-shaped. Why? Because they rise, they fall, and at the end they start rising as soon as they reach the optimum level. Get the point here? They are both U-shaped because as soon as output increases, the average cost and the marginal cost will fall. But as soon as it gets to the optimum level, they start increasing. That's when diminishing returns comes in. Do you understand that?
Yeah.
Then for the other one, we have the products and the cost curve. Yeah, I wrote marginal and average physical product rises when marginal and average costs fall, and vice versa. As soon as our marginal cost and average cost, as soon as they fall, it means our output has increased. That is why the marginal and average physical product rises. Our MP and our AP would increase because our MC is falling. But as soon as our MC starts increasing, the AP and the NP will start rising.
Okay.
Do you understand?
Yeah.
Your product, the product you produce, the total product, the marginal product will rise as soon as your MC and your AC falls. But as soon as your MC and AC start increasing, your MP and the AP will start falling. Is it clear?
Yes.
Any question about that?
Yeah.
Then in summary, we have our AC curve. Our AC curve is always above the marginal cost curve if our average cost is falling. As soon as your average cost is falling, your AC will be above the MC. But if your average cost is rising, your MC will be above your AC. Put that in note. AC is above MC if average cost is falling. MC is above AC if average cost is increasing. Is it clear?
Mm-hmm.
Then we have our AC and MC, which is already equal, which is U-shaped. So those are the things you need to know about AC. Your AC curve is above your marginal cost if it is falling. Your MC is above it if it is rising. Then your AC and your MC are always what? U-shaped. Why? Because there's always diminishing returns as soon as both reaches the optimum level. So that ends cost. Any question about cost?
No.
Okay. Then you have the activities to do.
Mm-hmm.